republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much. Now, at this time, is there anyone who would like to address the committee? Okay, hearing none. We'll move into our item number 4, Community Development Monthly Reports from Pete Preston.
Thank you, Mr. Chair. In the month of September, we have 34 building permits with 3 new home starts, a little bit of commercial activity. We had 36 zoning permits, and we had 77 code enforcement actions. Other than that, we're starting to see a little bit of an uptick here since construction costs have come down a little bit. However, overall inflation is still keeping it somewhat stagnant.
Any questions for Mr. Preston?
How's the solar permits going?
The solar farms, I was actually out there today and had a meeting. Assembly, there's 3, Assembly 1, 2, and 3. Assembly 1 has been finalized out. We do have a couple little things that we needed to wrap up there. Assembly 2 is asking for its finals, and Assembly 3 is a couple months, or not a couple months, maybe a month or 45 days after that. However, we do have, as always, at the conclusion of something, some things that we want and some things that they want. So that's why I was out there for a couple hours today.
Oh, so 3 is coming along pretty quick too, right?
Yeah, they're going as fast as they can, but one of the things that we want to make sure of, though, is that as they final out of these, that the restoration of some of the laydown areas, some of the ditches, some of the drives that they've cut were maybe, a few feet off from where they were supposed to be, that we're continuing to work with them on.
Okay, thanks.
Yes.
Any others?
Thank you.
Thank you, Mr. Preston.
Thank you.
All right, we'll move right into our agenda items then. We'll start with item A. We'll entertain a motion to approve the 2021 drain assessments as proposed.
Support, or make the motion?
All right, we have a motion
Support.
and support for item A. Questions or discussion regarding the item?
Our drain commissioner is here with Jenna. Do you have any questions?
Questions? Hearing none. All in favor of moving item A forward signify by saying aye.
Aye.
Any opposed? None. Motion carries. Move on to item B. We'll entertain a motion to approve the apportionment report and direct the spread of taxes in terms of millage rates to be spread on taxable value.
I'll make that motion.
I'll support it.
Item B, moved and supported. Questions or discussion?
Just sets our tax rates for special assessments.
Hearing none. All in favor of moving item B on to a Wednesday vote signify by saying aye.
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 Any opposed? Motion carries. Now, move on to item C, and we'll entertain a motion to approve the PA 116 farmland agreement application for Mr. Tom Elbaugh, Albaugh, for his property located at 7201 West Riley Road, LC.
I'll make the motion.
Motion
Support.
has been supported. Item C, questions or discussion regarding this? None. Item C, all in favor signify by saying aye.
Aye.
Aye. Any opposed? None. Motion carries. Item D, we'll entertain a motion to approve the bid documents as presented.
I wasn't sure, is that on the parks? Oh.
So,
You want to clarify it?
yes, so what it is they're going to be going out to bid, and these are the bid specs.
Oh,
So we're approving them before it gets placed on the website.
because I see that it said approval of the parks planning the next one, so I was a little confused which one was first.
Yeah, this is for the 850 feet, 8 feet wide limestone trail
Yeah,
walk.
I see the bid, yeah.
Yeah.
Okay, I just want to clarify. Thanks.
Mhm.
I'll make the motion.
We have a motion for item D
Support.
and support. Questions or discussion? Additions or subtractions? Any thoughts on that? It's pretty good to me.
It'll go up on the website, and there'll be a bid process, and then you guys will award the bid.
You got a time frame on that?
And what's our time frame?
I think that we're just gonna take low bid, from what I understood. It was
30 days.
Shortly, yeah. They've already, I think Ron had a couple bids, they were under $5,000.
they come in under 5,000, it won't come back. But if it comes in over 5,000, it'll come back.
Understood. Okay. Committee mates, anything else? All right. Item D, all in favor of moving it forward to Wednesday, signify by saying aye. Aye.
Aye.
Any opposed? That motion carries. And for item E, our final motion, we'll entertain a motion to approve the board appointments to Parks and Planning Commission.
Can we name those people just for the public here, so we have,
Great, that's it.
It is,
Is this what we are carrying up after last month?
yes. So, Tom Sverchek,
Tom Spurcheck, yes.
Bonnie Reno. Okay,
Two is our fault?
yes.
Yes. I hope we got that name pronounced correctly.
You want to know which one's which for the record? Bonnie is for the parks.
Yes.
Yeah, I
So we
know
know
Tom
Parks,
Sverchek, I know him personally, he worked over, like he said, over in Swartz Creek as a manager over there. He's
So these are the
retired.
names we want to move possibly to Wednesday.
I'll make that motion.
Yeah, I'll support it.
Moved by Commissioner Webster, supported by Commissioner Olshausen. Item E, questions or discussion? Are there any questions after 2 months of this, right? In that case, item E, all in favor, signify by saying aye. Any opposed? That will be added to Wednesday's agenda. Thank you. Are there any other comments by our committee members at this time? Regarding the actuarial risk? All right, this is our second opportunity for the public to address this committee. Yes, sir.
I had this made out, Mr. Chairman, but I didn't get up.
You're up.
Would you like me to give it to you or give it to Caroline yet? And thank you, board members. My name is Danny Miller, and I might need about 1 extra minute. Pass that 3, please. I am bewildered, I am perplexed, and I am dumbfounded that when I went to the September 13th 9 a.m. meeting, which was held here on the change, was item C on our agenda, the change for going from 7 to 9. And that's why I'm bewildered, perplexed, and dumbfounded. But because I attended all 3 of those meetings at the community center in Corona, the theme became very apparent to me that the word change was being said over and over. We want change. We want change. But evidently, the desire to change was not there. Because come that meeting on the 13th September, and I have a question later on for that, I asked myself, and I asked a lot of people I have coffee with, that I sit down with, and there aren't too many coffee shops I get up and walk away from. The more commissioners, the better representation. The more authentic the representation. The citizens, I believe, spoke loud and clear. Change. More open and transparent representation. Change. Not loud, not clear enough then, evidently. The audio somehow went off. Somehow, somebody turned off their radio. They didn't want to hear something. So, give it a try. That's also what was being said. Someone must have turned off something where it didn't ring through. Again, this was item C on that agenda for the 13th of September, and the discussion didn't last long. It was introduced, and immediately, Scott said no, Julie said no, Mary said no, so immediately it was already gone. And what also was there, Mr. Zaccarda, chairman of the Democratic Party, put out a Michigan counties relationship before 2020 populations. None of it was really discussed, such as 15 counties. One county, Montcalm, has 666,600 people. They have 9 commissioners. The other 14 range between 18,000, 17,000, up to 75,000, and they have 7. Only one has more population than us of these 15. Thank you. Do I get the extra minute or so, sir?
Committee mates, what do you think, extra minute? No, can we just have you give your extra minute here at the second half of the meeting?
Absolutely. Why don't I take the 3 also at that time, and I'll...
There you go.
Thank you, sir, I appreciate
Sorry,
it.
it's not really up to me.
No, it's all right.
Anybody else at this time who would like to address this committee? All right, this committee meeting is adjourned.
Finance will start in a few minutes. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Okay, Dan, you can call the vote.
Thank you, sir.
Yeah.
Oh, that's me.
It's same guy.
Same guy, all right, thank you. So basically keeping, by the way, I am referring to the apportionment committee that met, not redistricting. So basically, I see that people say, let's just keep it safe. Let's just keep what we have. That's not what I asked for. That's not what a lot of people asked for. Well, why vote then? Why do I come to a meeting, and why do people come to meetings if you're not going to make some change, or we say, oh, that's okay? Because if you must stand for something, or you stand for nothing. Now, change ain't looking for a call to be friends. It calls us to dance to a different tune. And that's what I'm feeling from this committee, from this 7 members already. So refusing to face the facts does not change the facts. People asked for a change. They wanted 9. Many of the people I've talked to, I don't think it was hubris that caused the 7 to remain there. Hubris is arrogance. I don't believe anybody on that committee was using hubris. But it just amazes me that we are not saying change. What would it hurt? Somebody said, well, it cost us money. Well, we spent a whole lot of money on extra things in this last 4 years that need not been spent. The lawsuits and everything else that have gone through. Maybe with 2 more representatives, the authenticity of representation would ring much clearer. But we're not going to, I don't believe we're going to see that. So, again, out of those 14 counties, we could have been one that went to 9 very easily. And I'm just looking for somebody to say to me, you know, let's have some change here. Maybe we could get somebody different, new. I'm not talking about the recall. Because you're gonna vote, you're gonna go to the polls and vote for certain people. Ladies and gentlemen, not to have a change after everything we've gone through, after what I heard in three community meetings, where anywhere from 100 to 300 people spoke, or I'm sorry, attended, and numerous people spoke, and I heard the word change come out many times, and I am not deaf. Mr. Chairman, is it proper for me to at this time ask Caroline a question?
No.
Okay. Thank you. I'm done and I appreciate the extra time.
Thank you, Dan.
Thank you, sir.
Okay, at this time, we have a special presentation. Louis Orcutt from Huntington Bank. Gentlemen, you have the floor.
Yes, so today we have Lou with us, Andy, and Eric. And these are the individuals that we've been working with on our bonding project, but they're here to talk to you about bonding in general for our larger conversation related to pensions and pension liabilities, where MERS will be with us later this week. But with that, I will turn it over to them.
Welcome, gentlemen.
I'm happy to be here. You guys all excited for a fun conversation? Pensions are always fun, right?
Let's take it.
It's just like a movie script.
It does. I assure you this is a better conversation than most popular topic.
Taking over 1,000 hours of my time.
Wow, what's that over today?
So I can start off the discussion here. My name is Andy Campbell with Baker Tilly Municipal Advisors. We're the county's municipal advisor. We've been working with the county since we were brought on by Brian to work on this issue, and then also we suggested doing the refunding or refinancing, as it's called in common terms, of the 2010 bonds and lease agreement. Just as some background, we work with about 300 or so communities in the state of Michigan. We work with the city of Durand, which is where we know Brian from, obviously, and Shiawassee and a bunch of other communities in this area. So we are the county's independent financial advisor in this case. We work with the county on what are the best options to pursue this. Does it make sense to pursue it? What is it? And we're going to talk about all this type of like what are pension bonds in a broad sense, just to make sure everyone's on the same page here. What are we trying to accomplish? And then we look at, from an independent standpoint, of where would you sell the bonds and how would you sell the bonds if you do pursue the option here. So to start, you'll see on page, it's right after the financial overview and process, it's page 4. I'm going to go through just kind of an overview of everything here, and then obviously if you have any questions, feel free to stop me throughout the whole thing here. But pension bonding is becoming and has been very popular in the state of Michigan, and a lot of it comes down to, it's very similar to a refunding. When you have a liability that's it's actuarial valued out in terms of you have a pension obligation to these retirees, and the actuarial assumptions say that you're going to have to pay this amount for this many years, and you're trying to take that obligation and refund it essentially into a lesser obligation. So it's very similar in the sense of taking the 2010 project that we're pursuing right now and trying to take debt to refinance it at lower interest rates. This one's, you're taking actuarial assumptions and trying to lower the obligation. With that in mind, it obviously has some major differences. The major assumptions are they're not set. The 2010 bonds, we know exactly what the obligation is, we know exactly what the principal is, we know exactly what the interest rate is, and we're trying to refund it into another obligation that we know exactly the bond payments and exactly the interest rate. And you can compare the two and say we won in the end and save this much money. When you look at a pension scenario, you're looking at actuarial assumptions of this is what our potential obligation is, and you're trying to refund it into set bond payments. The bonds will be set interest rates or fixed interest rates by maturity. And essentially, there are risks there, and that's what we are very upfront about when we talk about this with clients. There are risks there to say you're going off of actuarial assumptions, and there's market risks we'll talk about in a second. And essentially, you're trying to hedge the fact that you need to achieve enough, basically buffer to make this worth your while. There's processes in place both with the law. The law is very conservative in the state of Michigan, and I'll talk about that compared to other states here too. But there's processes in place, there's laws in place to make sure that the county is going to receive good advice from the financial advisor, the bond attorney, the underwriter, that you're going to do the right things when it comes to what the best decisions you can possibly make financially right now, and then setting yourself up for the future. One thing that you might see if you look in the news about pension bonds that we talk about is that pension bonds do not have a very good name nationally. One of the big problems if you look at other states and how they do pension bonds is that they allow them on open systems, which means that the community in, let's say, another state would issue the bonds, but their system is not closed, so they equate it to putting water in a bucket with holes in it, because your liability is still going up, an unknown liability, because people are still coming into the system. There's still an unknown liability at that point, and all you're doing is just adding more money from the bonding perspective to that unknown liability. That's one of the major differences between Michigan and other states. Michigan's very conservative in that you are required to close the systems, which the county has. New employees are not allowed to come into the system. In essence, you know the employees that are eligible. It's just the other side of the equation. To put it bluntly, it's a lot of death tables and such that you're relying on. Yes?
I know you're on a roll here, but I'll
Yep.
forget my question if I don't ask.
Yep, no problem.
Talking about these actuarial assumptions, and I know actuarial assumptions are based on very large groups. Our county, of course, is not a very large group. Is there, I guess, an experience or so on? What is the experience of doing this? How accurate those actuarial assumptions have been to the greater or the lesser? Because if it's we're under assuming and our obligation becomes more, obviously, then we'll have to deal with that in the future to a lesser degree, of course, because we'll have bonded. But I'm just wondering, are they usually within 5%, 50%? How good are the assumptions generally?
I gotta say I have no clue, because you're in MERS, if I remember it right. Yeah, that's a good question for MERS. MERS is who's providing your municipal employment retirement system. I will say from the outside looking in, MERS has had some major changes in the past few years. Now, the thing to think about that, though, is that if they change their actuarial assumptions, that does not change your outlook, in the sense of you still have to have those liabilities. It's just whether or not you are funding them with bonds and debt payments, or you're funding them with general fund, whatever funds are contributing to that in the end. If your liability is $2 million because MERS says it is in 2021, and you issue bonds to cover that and lock it in at 0.5% interest rate, if MERS says you have to come up with another $500,000, you would have still had to come up with that other $500,000 no matter what. It's just that you're trying to make an educated decision to lock in some of the liability now and put in the investment money to capture some of that liability. Essentially what you're doing right now is you're taking an educated decision to borrow the money, invest it in MERS, and get market returns off of that are better than your bond interest rates. That's
One thing though, it's a great question, because that's always the big question, because it's not an exact, like a refund, everything's set. You're kind of hedging a portion you can control, and the portion you can control and lock in is interest rates today. We all know that we're historically low interest rates. Under the law, we'll talk about this comprehensive financial plan we have to put together for the state to get approval to do these, and we've done, it's been, well over, I think, 35 issues done in the state of Michigan. And all three of us have been involved in numerous of those issues. But under the law, we have to analyze the numbers based on current rate of return that we're assuming right now, and then we look at the same data with the rate of return being 100 basis points lower. So right now they're assuming 735. We look at the numbers with rate of return of 635. We look at the numbers at rate of return of 535. And then we compare that to interest rates in the current market today, plus 50 basis points and less 50 basis points. We kind of load that in the matrix to kind of get, here's your spectrum of savings, from the high part to the low part. And the law specifically lays that out. So there's not, cutting super close. If you have just a little bit of a change in the market conditions, it kind of kills your savings. So when we look at these numbers based on where you are today, and that's the clear piece, there is an assumption that, if you're only, right now you're going to borrow under the law up to 95% of your liability, so you can fund 95% of that. If your rate of return drops a little bit, ultimately that funding level, in theory, drops down a little bit. But that may go back up the next year. It all depends on how that rate of return is. But at least we know the two spectrums that we're talking about, the high and the low. One thing we can say is we do know when you borrow your money on today's market rates, we're talking about rates of 2.3% or so over the next 20 years. So one thing to keep in mind is, well, if my rate on borrowing money is at 2.3, I got to clear that bogey for my investment rate return, which you have a much wider spectrum of investments to pick from to do that in your pension fund. And MERS, I would say of all the issues that I have done on pension bonds in Michigan, I would say 80% of them have been done with MERS. And we've been pretty close. We had some fluctuations. And this goes back to 2012. So you have your ups and downs with the assumptions. But for the most part, the savings have been pretty strong. And we haven't had anybody come back and say, listen, we've had a really huge drop in our rate of return. Can you please rerun the numbers to see where we're at? We haven't had anything like that at all. Good. Hopefully that answers your question. I think once we get through some of the numbers in here, you'll kind of see how that is played out a little bit. Sorry, go ahead.
Yep. So on the risk side, so there is the actuarial risk too as well in here, and that you're relying on actuarial numbers from MERS, and those numbers will change as their actuarial assumptions change. And I know that a lot of communities went through some big changes in 2020. Some of that was counteracted with investment rate of return that were pretty successful in 2020, and they're looking pretty good in 2021. But you are, that just as Lou said, that's not something you can really control, but you're trying to minimize all the risks that you possibly can with this type of issuance. The other risk that that we mention here is interest rate risk on the bond side. There is a point, and we basically let Brian know, and he can let you all know this too as well, is there's a point where the consultants here work on flat fees that are paid out of the bond issuance at closing. And there's a point basically that you can go through this whole process and not incur any costs until you start the application process with Treasury and the rating process with Standard & Poor's. These have to be rated, and Treasury, the Department of Treasury for the state, has to approve this issue, and that's what Lou was talking about. We'll get into that, but Treasury looks at all these different scenarios, makes sure that all the numbers are in line and you did the process correctly per the law. And this is a lot more in depth than just a refunding like we're doing right now in the 2010 commitments. But so we'll obviously monitor that. Interest rates have risen in the last couple weeks a little bit. It's still very, very low comparatively, and when you look at historical interest rates, but they have started to creep up a little bit. But when we keep an eye on that, in the end, when you see the financials, it's there's a lot of savings estimated right now, and we'll talk about that. The investment returns are also a risk that you have to take into account. Essentially what you're doing here is if you fund these, and let's say it's $40 million or something, you would give MERS $40 million to invest on behalf of the county, and what your risk is that they invest that $40 million and do not get you enough returns to counteract the bond interest rate. And as Lou pointed out, we always look at the all-in TIC, which is the true interest cost plus cost of issuance, and that's 2.46%. So with that estimate, basically you can say like, hey, we have to get, in order to make this worth our while at all, we have to get 2.46% on an average rate of return for MERS. Historically speaking, they've been above that, but there is a risk there, obviously. If the market crashes, hopefully it doesn't go prolonged, but there is a risk there that if you invest this money and MERS does not bring the investment rate of return for the next 10, 15 years, however long your plan lasts, I can't remember off the top of my head, there's a risk there that you could end up worse off financially there.
But keep in mind, the county's a AA rated credit, I believe AA minus.
AA minus.
AA minus, if I'm not mistaken. And we can even look to get these bonds insured if it made sense, insurance rate to AA. It's probably, from a municipality standpoint, one of the safest, not the safest, but I would say even a high category quality, credit quality out there. That's going to garner the lowest cost of funds for rate of return. So, you know, if you think about it, if you took your entire investment pool of your investments and invested into a single A rated municipal credit and a bond issue, in theory you should have a higher rate of return than what you're borrowing right now. And we're at a very low interest rate environment as it is. So just by sheer interest rates going up, your rate of return should be higher. Because again, you're starting at about as low as a rate of cost you're going to have out there at a AA rated credit municipality in Michigan. You're not going to get much higher than that unless it's AAA. There's only 2 or 3 that are in the state of Michigan. There's only a handful in the entire country that would be. And even if you get to that premier AAA rate, your borrowing rate, it's not going to be that much lower. Maybe 10, maybe 15 basis points lower. So I guess what I'm saying is there's a lot more upside on your investment piece to clear that hurdle. You're in a good position. That's why these seem to work. That's why the state of Michigan under the law says only issuers that are A rated or better can actually even do this, because they don't want a municipality that has a AAA rated credit that maybe, you know, would load a higher debt load on them and the community that they can handle. And they run those stress tests as well. And then obviously what's the rate that you're going to pay on the bonds to make it worthwhile. So again, the law is really good from the standpoint it has a lot of hoops you got to jump through and a lot of guardrails. But the idea there is to make sure that we don't issue this and then 5 years down the road you're upside down. And that's the key, and the state really analyzes that so you don't get to that point.
So on the positive side, what you're trying to do here is you're trying to save money, and you're trying to take those obligations and you're trying to lessen the obligation over time. MERS scheduled out your obligation, it's 18 years, and you'll see that in a second here, but one of the secondary goals of this is that if you look at the obligation that MERS is scheduling out for the county, the estimated requirement is $4.1 million this year, and it rises to $6.1 million 18 years from now. And that's what most communities in Michigan are seeing, is that not only is it a lot of money for these communities, but it also is rising substantially over the next 15, 20 years for a lot of these communities to a point where some of them would not be able to even afford it. And the secondary goal of this, and that is required per the law, is to level this out. So you're trying to also not only save a bunch of money, but the goal is to level these obligations out so that when you know come budget time, barring everything working out in terms of, obviously there's actuarial assumptions, you got to sell the bonds. Again, the bonds are set once you're sold and closed, but the actuarial assumptions come in line. The goal is to level this out for the future so that when you're doing your budget, you're not seeing these huge jumps every single year until this is done. That's the secondary goal that's required. So we'll get to the actual analysis here in a second, but I just wanted to talk about a couple other things that I'm going to turn over to these guys. But this process takes a long time. It's very in depth in terms of the rating process with Standard & Poor's. The Treasury process takes a very long time right now. They're all working from home. There's a bunch of layers of approval. Overall, like a typical bond issuance takes about 4 months, call it. This process will take at least 6 months. From start to finish, there's a lot more steps. There's a lot more steps that have to start after the other one is finished, type of thing. So you can't kind of do things at the same time. You got to wait for this one to be done to start this process, to start that process. It's a little bit more drawn out process. I mean, if the county decided to go forward at some point, I mean, you can count on it's usually about 6 months from start to finish. The cost of issuance, make no bones about it, it is not cheap. We'll talk about the cost of issuance that is in here. The biggest thing to know is that all costs can be paid from the bonds. It's really up to the county what you want to do. All costs can be paid out of the bond proceeds. They're payable upon closing, bar a couple fees. The rating fee can be paid out of the bonds, but it is payable once you start the rating process. The same with the Treasury process. The rating fee is probably going to be maybe 30 or 40,000, somewhere in there. The Treasury process is, I think it's 2,000 capped or something.
2,000.
Yeah, so that was what I was talking about earlier, that we basically run it as far as we can to make sure you're still in the money, the financials are still looking good, the bond market interest rates are still looking good, and then we let the county know, hey, here's the decision point. If you move forward, you're going to incur those two fees, the rating fee and the Treasury fee. And then if everything goes smoothly and you continue throughout the whole process and close, then all those fees can be paid out of the bond proceeds and don't affect your budget. I'm going to turn it over to these guys to talk about their roles in here, and who wants to go first?
We'll go through the legal side, and then, go through the legal piece, and then we'll jump into the numbers, because that's, at the end of the day, what we're talking about is how much money you're going to save and kind of how the numbers work, so you can kind of visualize what you're doing here. But there are some legal pieces that you got to be understand, and that's a big part of the state, is to make sure everyone thoroughly understands the process is, because it's a little bit different than a capital improvement bond you do to build a road or what have you.
Thank you. Mr. Chairman, members of the committee, Dr. Boggs, thanks for having me here again. My name is Eric McLaughlin. I'm a partner with Dickinson Wright, the Municipal Law and Finance Group. We've been bond counsel of the county for since the 80s, so it's my pleasure to be here serving you again on this issue. Lou and Andy have hit on it. Michigan law authorizes the county to issue bonds to take advantage of this financial strategy that they have described. You can issue bonds to pay part of the unfunded pension liability and the issuance costs of the bonds. There are steps you have to complete, 4 steps you have to complete, and then you have to apply for Treasury approval. So the 4 steps that you have to complete are you have to prepare and review this comprehensive financial plan that they have mentioned. It's very detailed. There are many statutory requirements that myself and Andy and Lou will help you all navigate. We'll work very closely with Dr. Boggs and anyone else at the county that we need to get the correct information in that document. That will have to be approved, along with a notice of intent, very similar to an infrastructure, a bond to finance infrastructure. That notice of intent will be published in a newspaper. It will describe the maximum principal amount of the bonds to be issued, the purpose, the sources of payment, and the elector's right of referendum. It starts a 45-day referendum period within which 15,000 or 10%, the lesser of, file a petition. Let me start again. The right of referendum is that within 45 days of publishing that notice of intent, if electors in the amount of 10% of the electors in the county, or 15,000 electors, whichever is lesser, files a petition with the clerk, then it has to go to an election. If they don't file that, then the county may proceed through the process to issue bonds. The notice of intent does not require the county at that point to then issue bonds. It doesn't expire. It merely provides you half of the authority that you need to issue the bonds. The other half comes from applying to Treasury for Treasury approval, and once they've gone through your comprehensive financial plan and all the various statutory requirements, they issue an order of approval to issue the bonds if they determine that. So once the notice of intent is published, it has to be published in a quarter-page size in the newspaper. If it's too small, you got to republish it, and the clock doesn't start running until that quarter page is met, the quarter page requirement. Once that notice of intent is published, Then there'll be a timing decision to be made, but essentially the next step is to adopt a bond resolution, which authorizes the issuance of the bonds within certain designated parameters that I'll write into the bond resolution with the help of Andy and with the help of the market information that Lou is providing to Andy. Andy will produce bond specifications. I'll write them into the bond resolution. There will be parameters. The bond resolution will delegate authority, likely to Dr. Boggs, to determine the final details of the bonds at the sale. And we'll go forward from there. We'll prepare the bond issue, and at that point we'll apply for approval from Treasury and get into all the minutia that Treasury requires you to get into.
Just at a point that's very similar to what you just went through with the resolution on the refunding.
Yeah. I was gonna say, what he just mentioned basically is what the refunding piece, or if you're to do a new issue for a project, you're gonna have that. Next step, it goes on page 8, kind of falls into the Treasury overview and application requirements, which is basically the additional steps that Treasury requires for approval on these types of financings only. And again, the idea here is to make sure everyone fully understands what you're doing, the risks involved, and also the benefits. And that kind of goes into this comprehensive financial plan that you have to prepare and post. And matter of fact, you may want to talk about how we have to post it on the website when you do the notice of intent.
That's a good point. Yeah, once the comprehensive financial plan has been prepared and reviewed, it'll be approved by resolution at a meeting. That same resolution will also approve the form of the notice of intent. But before that notice of intent can be published, the comprehensive financial plan will have to be posted on the county's website. And then at that point, then you can go forward with the publication of the notice of intent. So as Andy was saying, there are a bunch of steps that have to be checked off in order before you can get to the next step in the process for this particular type of bond. And like I said, we're here to help the county get that done in the order that needs to get done in.
So on page 8 and 9 kind of gives some of these application requirements. The big piece of this is one, the comprehensive financial plan we talked about, which really is more of a full detailed description of the proposed bond issue, valuation. So go into and make sure we analyze your debt limit so you have enough debt capacity to issue the debt. It talks about the rating requirement, you have the rating in place to do that. All the sensitivity analysis with the numbers based off your actuarial reports, which are in here. I'll give you an example of those as well. And also just to make sure you check the boxes they have to keep the guardrails up. So it's not a financing that you are overstepping your abilities for repayment and you're going to be underwater quickly. That's the key part of this law. The original law was passed, I believe, in 2012, which had some restrictions. Basically, the 2012 law had three restrictions. You had to do a financial plan, you had to be rated AA category or better, and you had to produce some type of savings on that. And the plans had to be closed. But there was no requirement. When they renewed the law in 2018, they set the expiration date out to 2023, and they added a handful of layers in there that, from a process standpoint, it's more work for us on your behalf to check those and check the box and make sure we comply with those rules. But in the long run, it makes it a tighter financing from the standpoint you're doing more due diligence to make sure you're not going to be underwater with what you borrow for what you earn. And quite frankly, it also helps on the marketing of the bonds. And there's been numerous publications where you'll have bond specialists in the market say pension bonds are bad, but Michigan pension bonds have a lot of elements to it that make it a good investment from that perspective and for the municipalities. Now, there's some guys that say, well, in their opinion, it's never good, but they can tolerate it type thing. But the key things to this is, one, they lowered the rating requirement to a single A, which was kind of nice. And I think the thought process there was a single A community still is financially sound, and there's a lot of communities that really can benefit with these financings that fall into that single A category. That's why they expanded that piece. And the market rates will determine if it's worthwhile to pursue. They had a piece in there that says you only can borrow on your pensions 95% of your liability. And the way they define how you calculate that really kind of goes about 92%, 93%, and I'll get into it in the second page here, how they do the calculations, a little less than 95%. The idea is they don't want you borrowing more money than you need to on that. And if you did OPEBs, they lower it down to 60%, so it's quite a difference there. They put in a parameter in there that says you must have level debt service payments. So they don't want you to borrow money and just have a bunch of savings up front and load all the debt in years 10, 15, 20, something like that. They want a nice level debt service, you have to comply with that. What's the other one here? And then they had a net present value savings requirement, which wasn't, you had to have savings, but it was never a requirement. So essentially that yield that Andy mentioned, the arbitrage yield or all-in cost, use an arbitrage yield, which is basically the cost of the borrowing of the bonds, not including cost of issuance. You present value your savings back to that number, and you must have at a minimum 15% net present value savings compared to your debt service payments, compared to what MERS says you have to pay on their schedules. And we have to demonstrate that to the state and hand it into a schedule. You'll see these numbers we have here, you're well within those parameters, quite a bit as the numbers look right now.
Real quick,
yeah.
just to add to that, so on a typical refunding, to give you some perspective there, if you were like the 2010 ones that we're doing, the state law is that you have to be above 0. So if you're going to do the 2010 refundings like we're doing, I mean, you could just, if you save $1, then you're permitted to do that by state law. The industry standard that we use to advise communities on is above 3%. So typical refunding in the market, if you get above 3% present value savings after costs, then that would be considered a fiscally responsible refunding. So with 15%, what that's basically doing, why they built that into the law again, is it's based on actuarial assumptions. These are not known debt payments to debt payments, it's actuarial assumptions to debt payments. They're building in that buffer to try to guard, to present the guardrails, like Lewis said, to make sure that you're not putting yourself in a position where you're running this too tight. Also on the 95% thing, keep in mind that unless something really changes on how well MERS does in the future with investment returns, there will always be you'll see it in the analysis here, it's an additional budgetary amount that you're going to be contributing every year still to MERS. This does not say, hey, we issued the bonds, now we don't have to think about this for the next 18 years. There's still going to be an unfunded portion that will start out around 5% that needs to be built into your budget, and then that amount will change as the actuarial assumptions and the investment rate of returns are updated with MERS information. So it's not we do this and we never have to think about the system anymore type of thing.
Yep, and then on page 10 there, and page 11, they said bond sizing requirements. Like I said, they say you can bond, so we're talking about pensions here, so we're only going to refer to the pension discussion, not to the OPEB discussion. But they say you can borrow up to 95%, but the way they film 95% is you take 95% of your liability less your assets. So when you kind of do that calculations, in theory, we used to, before this, we would say whatever your net liability was, we take 95% of that. But now it's 95% of your liability less the assets. So when you do the numbers, it usually comes out to be something a little bit less than 95%. But that's how we calculate that, which kind of give you a little diagram on page 8, just what we go through. And you get the amount you're going to deposit to MERS for that payoff, or whatever that amount is. And you could do anything up to 95%. You don't have to do 95%. Many times a lot of issuers like to do 95% just because if your rate of return goes down, you're not going to be lowering your amount that you borrow out of the gate. And then we have a piece there where you can plus in the cost of issuance in there. On the financial analysis, yeah.
I'm sorry, what page?
That was page 10, I'm sorry.
We're page 10 now.
Yeah, that kind of gives you a little bit, and we have actual numbers, you'll see this flow here as we roll. If you go to the financial analysis, we always look at both market and actuarial values, and depends on, we kind of give you what gives you the most, one, we have a higher borrow amount than not, so you can borrow more depending on what the market is right now, because the stock market was really strong last year. Actuarial values seem to be the ones that are at higher value, which previous 2-3 years was the market value, but they usually are pretty close. I wouldn't say you're not splitting hairs, but they're relatively close on those fronts. But we do look at the law, the weight, and all the schedules. We look at three things. We need to update these within 150 days. Whatever the numbers are from MERS, we get updated reports of 150 days to the issuance of the bonds, so we know it's updated data, most up-to-date data we can have. And then we look at three different variables. We look at the current rate of return that MERS has as their starting point, which right now MERS's standpoint is 7.35% rate of return. That's kind of what they set their actual numbers on. And we'll look at those numbers at a 7.35, a 6.35, and a 5.35. And if somewhere in this process MERS lowers that rate of return as their starting point, we'll adjust all the schedules. So it's always the current rate of return less 1% and less 2%, and that's how we have a matrix on this. And then we always look at analyze that with the current market interest rates, and we do a sensitivity of interest rates go down by 50 basis points or 0.5%, or they go up by 50 basis points. So, for example, on page 11, these are actual percentages that we talk about, that net present value savings we talk about, where we've got to be above 15%. So, at the expected UAL rate of return from MERS, which is 7.35, these are coming right from MERS reports from your guys' numbers. At the current interest rate, you can have 48.56% net present value savings, which goes into a big actual dollar amount, which I'll show you in the next page. And if you interest rates go up by 50,
Just going back, the minimum is 15, right?
yeah, yeah. So
by bonding, we would be at 48 versus the minimum, which is 15.
So if you look at that table, the best savings scenario would be the current rate of return and interest rates as of today if they drop by 50 basis points, which would give you about 55.4%. That's the top right-hand corner of that chart. Compared to, say, the lowest percent of savings, assuming that you only had a 5.35% rate of return, which is what MERS is, less those two categories of 1%, 2%, and interest rates today plus another 0.5%, you're still at 19.18%. So even at the stress test that the state wants to ask with their with the law, you're still within the 15% hurdle for the savings requirements. If you look at page 12, and this gives you an example of a savings report here. And this page right here is what we submit as part of your financial plan. And we also submit when the bonds are, the interest rates are locked in to the state of Michigan, so they have for the file, and they satisfy the savings requirement. So I'll just kind of walk through the columns starting from left to right. The column on the far left, without bonding, your total UAL payments. This is what MERS projects as of July 21st. What you would have to pay each year to satisfy your requirement each year for your pension, for all your divisions.
Can I
Yes.
ask this?
Yep.
UAL is unfunded?
Unfunded accrued liability.
Thank you.
Yep.
So this is our debt. That does not also include our current payments. So for example, our debt payments to MERS, our liability payment was $4.1 million this year, and our payment to them for what actually transpired this year was $1.1 million. So this is only the debt. This does not include
So
current.
it's 4.1 plus 1.1?
So you got what we occur in the year, and then what we're paying for in the past. This is only the past. We will still have the payments of what we have in a year, but we would be expensing out what happens in the year as the year happens.
So as we go here, and as we mentioned, we ran these numbers based on a 95% funding level per the formula, which would give us about 42,894,000. Footnote D is how much we would put towards your to MERS to satisfy it. So you'd be almost at 95% funding. And then we show you by doing that your principal amount of 43,845,000 plus your interest due on the bond. So the next three columns would be interest, principal, and total principal and interest payments of 53 million. So essentially, before bonding, you owe MERS through 2039, $92,998,000. If you bond for it, the bonding cost is $53,384,000 plus, if you go to column D, that is the 5% residual that we did not bond for, the portion that we did not bond for. And when you do the combination of those two, if you go to the savings column there, the difference, you're essentially saving $26,839 over the next 18 years on that. And again, that savings will fluctuate up and down. But a couple things, as Andy mentioned, you can see your debt, your obligation payment now is nice and level, about 3.7 million, 3.8. It's kind of locked in compared to that escalating payment you have. And you have quite a bit of savings. Now, as your rate of return goes up and down, those savings go up and down. But for the most part, you're still at 26,000 in savings. If you present value that back to at the arbitrage yield, which is basically the rate of the bonds less the cost of issuance, you're at 21 million, which gets you that 48% present value savings. So a lot of buffer there, and there's an incredible amount of savings on that front. So this is just an example that we're sending to you. If you go to page 14 and 15 is kind of where we get to those numbers. And I'll go through this, I know we're taking a long time here, so I apologize. I showed that chart, kind of how we did the formula with just the line items with definition. Page 15, you can see the number. So right now, without bonding, for actuarial value, on all your divisions, we listed up on page 14, so we looked at all the divisions. You have about $136,600,000 and change is your current liability. Your valuation of your assets is 86 million, so your unfunded liability is about just over 49 million, so you're at 64% funded right now. 65% on market value, give or take. The sizing of the bond issue, we mentioned on right below there, is we take your liability, 95% of liability gets you the net liability we use for bonding purposes, less your assets, gets you the amount that we would send to MERS at closing. So if we close this bond issue today and we use everything rate, we'd send MERS $42,894,000. Yeah, and ultimately the goal there, and you see the cost of issuance about $950,000. That's legal fees, underwriting fees, rating fees, everything else.
Cost of doing business.
Cost of doing business.
Hopefully that's high.
And by the way, we're being conservative here, so I don't want you to say like this is going to be higher than that. We're kind of conservative on this front. But the idea there is to get you to your funding ratio pretty close to 95% at closing.
I have a question.
Yes.
Okay. So, if we send a large amount of money to MERS, like you just mentioned, does that move any of our numbers from MERS? Do we get a better rate of return if we have a smaller liability? Nothing like that changes. Nothing, interest rate doesn't change,
In theory, it shouldn't. Well, the answer, you're right. No.
Okay.
In theory, you almost, they got a bigger pile of money to invest for you right now. In theory, should have a little better rate of return than normal. But I can't speak to how, you can talk to your MERS representative how they invest all those pools of funds. If you had an independent manager of your pension fund, that question would be like, yes, we can change the investment risk model a little bit, you have more money to work with on that. That's a good question for MERS. Now, like I said, most of these issues we do for spending are through MERS, so I'm quite certain they've had that question, and I'm sure your MERS representative can explain how they do that. But we kind of work off the assumptions we have here. And this table here kind of shows you, how we get the sizing of that. On page 16 is really, the next few pages is kind of the meat of the matter as of right now. What we broke it down here is, we'll just do actuarial value at the top, market values in the bottom, but the exact same numbers, is that stress test we talked about. This is just current market interest rates right now. So it doesn't show the fluctuations of plus 50 basis points minus, but it just shows your savings based on a 7.35% rate of return, which gets you your savings. It shows you at a 6.35 rate of return in your savings, and it shows the par amount of the bonds and what the percentage would be, and the 5.35. So you can see the savings going down from 26.8 million to 19.9 million to 13.6 million. at an interest rate of 2.3%. So this is the part where we're going to say this is your range you can think of. So I would say if your questions come up from your community,
Yeah, I have a couple questions. Can these bonds be retired early?
could you pay them up? Yes.
Yes, so if we do an 18-year bond issue, typically you're gonna have a 10-year call period, which is protection against for the investors.
for
The
the-
first 10 years, no.
But after the 10 years?
After the 10 years,
Yep.
yes.
Okay, also too, so let's say that we form a plan. Everybody likes it. And then we decide that we can stick $6 million in the pot. Well, of course, that would lower our obligation per year, wouldn't it?
If you decided that you had extra funds that you wanted to
Yeah,
contribute.
in our discussions before we got it really rolling,
Yeah.
and we had extra cash possibility, that instead of being a payment of, an average payment of $3 million, whatever it was.
Right.
And that got down to 2.5 or 2.4, I mean, to our county and our budget, that's a lot of money.
Right.
Yeah, 'cause our budget,
Mhm.
right now, the money we're taking, if we have to spend $6 million plus $1 million, $7 million out of a $17 million budget is.
That's a big number.
That's a big number.
Yeah.
Yeah.
And it changes each year.
Yeah, so basically, I mean, when people say that your SEV will grow, well, it's starting to grow again. It didn't grow there for a number of years. Of course, hopefully you'll grow somewhat out of your debt, because if the SEV keeps going up, it helps. Those are some questions, but basically, like you've indicated, we've had cities, counties, some townships that were big, that have gone to this plan to make sure they can stay afloat.
Yeah, they've gone to the plan for Act 202, where you have to meet the requirements of state at certain funding levels. They've done this as a tool to get them, as their credit plan, to get above the minimum funding levels is there. But you're absolutely right. If you have extra cash to put into the transaction, ultimately you would just borrow less of a percentage. Maybe not 95%, we do 80%. Whether or not you take that $6 million today, or whatever the number is, instead of the MERS, or maybe just kind of hang on to it and make additional payments on top of that.
Yes.
As a buffer, that's one way to do it. But the biggest thing on this is what you're doing is you are doing an arbitrage play. You're going to borrow at low rates with the event that invest at a higher rate. And you're very restricted to the most conservative investment that's out there, which I would call a AA rated municipal bond, which carries a low rate of return because it's so safe, compared to a mixed bag of goods that MERS invests in, includes equities and things of that nature, which most pension funds are done to get a proper rate of return.
Also, just for everybody to know that we are entertaining other bidders for the money. I mean, basically, who would handle the bonds money?
Oh, gosh, other than MERS?
Other than
Right. Yeah, and that can be done. As a matter of fact, Andy and I worked on a transaction with our municipality. They literally switched in the middle of the process.
Yeah, they switched to Merrill Lynch like halfway through the process. I mean, I don't know what's going on. I mean, I know that some people are not happy with MERS, so I will say that's not unheard of. I will say that. Then that's perfectly fine if you guys decide that you want to switch to XYZ company, then
Should we
switch.
take the MERS number at the beginning of this process, because another administrator might have a different number, of course. At what point do we lock in, we're going to base it on 95% minus, et cetera, we're come to an effective 92%. At what point in this process is that locked in, whether we switch or not? I'm just thinking of this.
From the debt perspective?
Yeah, you're gonna want it, basically, with this 6-month process, let's say you decided, and we're not asking you to do this today, but let's just say you said, move forward today. I mean, you're not gonna close until April or May of next year. At some point, I mean, it's pretty much right around June-ish. I think the 2021 fiscal year end report would come out from MERS. at some point, you're gonna have to make a decision based on the timing of how close are you to switching, if you are gonna switch your plan, and do you want to get them to run an analysis to check MERS and get a second opinion? That community, I mean, by their decision, basically what we talked about was, they trust MERS enough that the actuarials are right, and they wanted to get in the market before interest rate changed, so they used MERS actuarial assumptions and changed the plan fiduciary to Merrill Lynch. It really depends on where you're at in the process and how quickly you want to get it done. If you are not in any rush and you're in interest rate wise and process wise, maybe you get a second opinion from the new company if there is a new company, and then obviously the bonds are on hold, but it doesn't matter to me. If you guys want to wait and have that company run everything, that's fine.
One thing I know that MERS uses a company called, it's
GRS.
GRS, it's an acronym, the exact name. What is it?
Gabriel Reader and I forget the S.
As their actuaries. And I think they do actuarial reports more than just for MERS, they do for other plan administrators. So I think in this case, they were satisfied, and this wasn't necessarily MERS numbers, but it was GRS's reports, and they were satisfied with their reports, and they were able to get a hold of them and then look at them. Again, I think Andy's correct. You kind of do however you want to do it. I would say if you're in the mid, like, let's just say you guys as board decide this is a good idea, you should move forward, and we go through the process. Probably the easiest thing to do is to get this done and get the monies deposited, and then let the new plan administrator do the transfer conversion from MERS over, because then you're not, you know,
Doing two things at once.
you do two things at once on that, and if we know all the money is going to go there. You know, from the perspective of the bonds, they'll be closed, interest rates locked in, that's all taken care of, and that's one less moving part as you're trying to move the plan on that front. So they'll know at that point exactly how much money you have that's coming over, and then they can start that process.
Okay.
But Andy's correct, it's not about timing. And the only thing on the timing perspective I'd say is the process takes to get there and look at where interest rates are. And
Well, we're gonna have to move it along here. Any other questions at this time?
Yeah, I have another one.
Yep.
First of all, this has been very helpful. Thank you. It makes the process clear, at least as clear as you can make it to
Right.
me. But I do have sort of another general question. I'm always looking, I see lots and lots of upside here. I'm not seeing a lot of downside. So just theoretically, you know, aliens invade Earth,
downside.
the market crashes 40%. Now, that would give us serious trouble, but it seems to me like it wouldn't really affect whether we bonded or not, because if we don't bond and we have a major correction in the market, we end up having all those return on investment assumptions not work for MERS anyway, and our debt just goes, that is what we have to pay. So is there another downside I'm not seeing?
the downside you're not, well, I would say you're not seeing. The downside that's out there is you are exchanging a cost for a cost. So you're exchanging the cost you pay MERS on an annual basis with a bond debt service payment. But you're exchanging a hard cost, debt. If you miss the debt payment, now you're in default, and that's not good for the county. If those happens and MERS says you owe us $7 million, and you say, you know what, I can't, I'm gonna give you 4, you're just gonna be that much more underfunded, but it's not going to affect a default per se. It's not, won't be a technical default on the county. That's the biggest risk that you're seeing. You're exchanging a soft cost for a hard cost.
Remember financially too, your biggest risk is that you don't beat the all-in tick of, in this case, 2.45, and in the end, you took a $96 million liability and increased it. That's what your financial risk is. You need to beat MERS or whoever your plan administrator is for the next 18 years on average needs to beat that to make sure that the county came out financially better. That's the big, so I agree with Lou. I mean, there's that risk. You're definitely, I mean, you could, like a lot of communities, delay payments to MERS and just deal with the state when they come knocking on your door that your funding ratio is not up to snuff. But the bond costs and the investment risk is there. You gotta be, this is the major decision that you're gonna make is, are you comfortable with the fact that the interest rate on the bonds, that your plan fiduciary is gonna be in a position to beat that in the next 18 years.
I will also say that, looking at what our unfunded liability is, without barring any kind of major economic growth, like a giant factory or something, there is no way that by the end of this decade, we'll be able to make the MERS payments without laying off people. And by the end of the next decade, the county will have contracted instead of expanded in as far as human resource capabilities to be able to make these debts.
Yeah, like I say, that's
It kind
definitely,
of lays it out there.
yeah, it does lay it out. The risks are out there. It's kind of funny because I will say this is an opportune time to do it because rates are low. Even some of the first issues that were done in 2013, 14, and 15, these issues were done when MERS had the rate of return of 7.5, so not much of a drop. We've actually refunded those bonds. So people issued these pension bonds back in 13, 14, and 15. At those rates have dropped so much that we're able to refund it and lower that rate of borrowing even lower. So I don't think you'll be able to do that if you issue in the next 6 months here because there's not much more to go down. So it's so I guess I'm saying your market timing is good to be talking about it.
Yeah, we've done a lot of background work.
Yeah, on that. So
So we're moving
if there's
right along.
any questions you have, this hopefully this is helpful on this, and obviously any questions.
And also but if we have one figure that we pay out per year for our debt, not what we're obligated that year, then of course it's a lot easier to, our
Right.
budgetary process.
I always found that that's the biggest thing. I've told communities when we do these, savings is number one, but right behind it, number two is the budget stabilization piece of this, because you see those growing numbers.
Yes.
And yours is a perfect example of it. Yours seem hitting more. A lot of times I see the last 2 years where it kind of drops off drastically, but you're still
I mean,
growing.
even if, also too, is if our investments are better than, let's say, 6.35 or whatever we use, well, whatever, there are 7.35, then we're making money, so to speak, each year, and that goes into the pot. I mean, so after the 10-year, requirement, we may be in a position where we retire a good portion of the debt.
That's right.
Yes, and then that each year of the $3 million payment, and plus what you owe or whatever it is, could be substantially lower.
Absolutely.
Yes.
The big thing here is, is just understand that you're not going to eliminate your entire pension obligation by doing these. It's this piece, you're locking in a good chunk just to take advantage of a low interest rate environment.
And actually, that's why when we, you discuss this in MERS, you spread it out over the next 30 years, so they go, no, it's gotta be this type of plan. Okay, any other discussion at this time? Well, okay, Louis and Eric and Andy, thank you for coming today.
Thank you so much.
For all your work.
I appreciate it.
Yeah. Okay. Okay,
So we'll have MERS coming to present on Thursday, and then we'll be able to have a much more robust conversation about next steps.
Yes.
okay.
I will say MERS is very familiar with this process too, so your representatives are, very
Yes.
familiar with it, so.
We finally got to talk to a financial officer.
Yeah. See you guys. Thank you.
Thank you.
Thank you, gentlemen. Thank you for coming. Okay, Treasury monthly report.
Mr.
Yeah,
Chairman,
there's Julie.
Did we finish with public comments?
Oh, no.
Yeah, we did.
Did we?
Public
Okay.
comment and then the special presentation.
Yeah.
There was one part, I didn't know if there was anybody else. Go ahead.
Any other comments about the presentation today? It's pretty good.
It was. Very
Okay, Julie, you're up.
Hello. You've got our bank reconciliation report. The two pooled accounts that say they're reconciled through August of '21 are through September of '21 now. Dealing with the bank changes, it'll all be good, just lots of little hiccups.
We hope they don't get bought out again soon.
Right. So it's gone good, just an adjustment. Got a report from G2G for our quarterly share. We should be receiving slightly over 1,600, and I just think that is nice change from instead paying out in fees over $1,000 per month. So just thinking that's a good change we made this last year, getting everybody moved to G2G, and gonna see that little profit share come in. It's not huge, but again, it beats those fees leaving us every month. The end of this month, October 25th, 26th, I'll be attending a land bank conference over in Lansing. So I will be learning what I can, and there will be a portion of it will be classes for specifically new land banks and things going on. It can also be viewed by Zoom. If any of the county employees want that link, I can forward that link to you so that you can also share in the conference.
Okay.
Other than that, I don't have anything.
Any questions for Julie?
Tracy and myself are probably going to participate by Zoom.
Okay, all right. Thank you.
You're welcome.
Okay, let's move on to our agenda items. Item A, I need a motion to authorize MERS to allow Brandon Worrell to purchase 1 year of service credit as requested.
So moved.
Support.
There's a motion and a second. You want to comment?
This is actually something that the board has to allow authorization to do through MERS, but the purchase price is completely on the employee to pay it. There is not a cost associated with them purchasing it for us, except that it adds to our liabilities.
Okay. Okay, any other discussion? If not, all those in favor say aye.
Aye.
Motion carries. I need a motion to approve the creation and posting of the Human Resources Manager.
So moved.
Support.
Discussion.
So this is something that we've looked at for a substantial portion of time now, based on all the different studies that we've done. And I think this is a position that we should create, and it has been funded in this budget. However, we have not expended any of those funds for it. We will be looking at doing some reorganizations as a result of it.
Very good. Okay. Yes.
Sure. Do we want to form a committee? I know we have the human resources study that we were all availed of and our efficiency study from MSU. So I would propose, Greg, that maybe yourself and the coordinator and finance director and maybe another commissioner.
I'd certainly be willing to do that.
I think that's a great idea.
We can come up with something by Wednesday.
You know, I think we have, like you said, talked about this for a long time, and we do have a lot of information available to us, and to really make this a true, efficient process.
That's a good idea. Thank you.
Okay. So we'll work on that. Hopefully by Wednesday we'll have some recommendations. Okay, all in favor say aye.
Aye.
All opposed, motion carries. Item C, need a motion to approve the revised Shiawassee County personnel policies as presented.
Moved.
Support.
Moved and supported. Discussion. I know we've discussed this forever.
Yes, Larry, you want to come up here, please? So, Commissioner Root, Larry, Amber, Shalette, Tracy, Ryan, and our HR consultant and myself worked at revising our current handbook to make sure that it met the current law, because things have changed, especially in the wake of COVID. We had a lot of changes to HR-related laws. So we have updated that. We also went through and updated a couple of things related to health insurance, which includes the buyout amount, the educational attainment incentives, which were way behind from what McDonald's was providing greater educational incentives by us by 4 and 5 times the amount. And Larry had an idea for a health and wellness initiative that we put in here with the proviso that if it is able to be funded in the budget, it would be funded in the budget. So would you like to hit a couple of the highlights?
Yeah, it's an update to the policy that we rewrote in 2017 that had been around since 1985. We rewritten it then. As Dr. Boggs said, we did a few things that could be good for recruitment and retention of our employees. You know, when you talk about health and wellness, having a reimbursement for like a gym club membership, that is a standard benefit that's being offered now. So, we put that in there. We also kept vacation and holiday the same for employees because that also helps for recruitment and retention, help offset some of the things about salaries. So I think a lot of work went into it. It wasn't the heavy lift that it was back in 2017 because we had already done it sort of recently. So I was happy that Amber and I could be part of it. Very supportive.
Very good. Yeah.
I have a question. Can I get a copy of the 2017 handbook just to make the changes?
Absolutely.
And then, I had a question. Someone mentioned that there's been a change in status of 64-hour employees, that they used to be full-time. So 64 hours in a pay period, and now they're part-time?
No, they're still considered full-time, because that's what we found out was part of the law. But the benefits that they accrue, such as vacation and sick time, can be prorated. And so this applies at the beginning to non-rect individuals. And then each unit, as we go through and update contracts, it then applies to them.
Okay. So this hasn't been, the provisions of this handbook have not yet been applied to people before we approve it?
No, it has not. None of that has been done. There was a couple of employees that received a prorated amount, and it has been changed and corrected.
Okay, thank you.
Yeah. And also in here is an internet, social media policy, and what we would call an exit interview policy. Mainly because now everyone has a laptop, they're able to take their laptops home with them. And so we did put it in a policy that in the event that you do not return your equipment, you do not receive your last paycheck or any of your compensation buyout related items, because we didn't have any policies on any of that because we didn't have laptops. So those are some of the things, but I do invite all of you, and we'll send it out to everyone, the 2017 one, so that everyone can compare it, and please read it thoroughly by Wednesday with any questions or comments you have.
I've read it, so don't send it to me. Thank you.
Well, we'll
You
just-
don't have to send it to me either.
Okay.
Yeah. Okay, well, thanks for all the work. I know an awful lot of department heads and elected officials and employees had a lot to say about this. Been going on for, what, about a year and a half now?
It's been
COVID kind of interrupted the timetable.
I think this started before I got here, and then it kind of was disbanded for a while, and then we rejuvenated it
Yep.
in the last 6 months.
Yeah, Larry really took the lead on this. I
Yep.
attended most of the meetings, and it was
See, that's how he got the grade.
a lot of work. Thank you, Larry.
Thanks, Larry. Okay, any other discussion? If not, all those in favor say aye.
Aye.
Motion carries. Thank you. Item D, discuss land purchase agreement. Doc, would you?
So we have negotiated a purchase agreement for the land that we discussed. And if the board wishes to move forward with it, now is the time to authorize that or not.
And the property is,
Well, the property is right next door.
I think it's a really good idea, personally. And I think we should.
But we've lost the ability for the corner, right?
We have discussed with them possibilities about the corner, because if we purchase that property, we will own the middle between two other people. And the people on one side to the north and to the south of us will be the same owners.
And they want to have congruous properties.
Contiguous.
Contiguous, yeah, that's the term.
My 2 cents, if I may.
Yeah.
Not on the committee, I won't be voting.
Yeah.
I would say to get my vote on this is going to be something of a Herculean task because given what we just heard minutes ago about our debt level and our finances and so on, the idea of entering into yet buying the property with the consideration of building a building and so on, all that expense I just can't see it. While it would be a nice to have, hardly to me something we have to do. It just, I can't even see going down that road at this point when our financial house is in such disorder. So.
I don't disagree, Greg, but when we go down to item F, that's more money than, you know.
It is, but this is just the beginning the building, we're looking at over $1 million. And if we're not gonna spend that $1 million, why do we need the land?
I've never lost on land. I think land is all, you can never,
Again,
Never.
nice to have, but I just can't see it. It's like, you know, I got $40,000 worth of credit card debt, and boy, somebody's giving me a really good price on painting my house, and well, my house doesn't really need painting, but you know, boy, that's a good price. But I have $40,000 worth of credit card debt. I shouldn't be hiring somebody to paint my house.
you got problems.
You know, I mean, let's face it, that's our situation. It's not something this board did. You know, this goes back, way back, but it's ours to handle. And, I just can't see it.
I agree, but I don't think painting a house is the same. Land's an investment, and again, you're rarely.
But I don't think I should invest in land up north either, with the idea that maybe it'll go up in the future. I gotta get my house in order before I start doing things that are absolutely necessary, and this isn't absolutely necessary. No, I do not have $40,000 in credit card debt.
That's probably gonna be in the Argus tomorrow, like on the front page.
I'll start a GoFundMe to help me. Who knows? I think Gary has.
Yeah, Gary's back.
I'm not on the finance committee, but we already got 23 acres out there to build on. And I took a tour of the old Griffin home, and there's, I don't know, several thousand square feet we're not using and heated. There's a big long hallway. There's a room there that's gym, they call it, 30 by 30, we're not using. There's also a conference room there that's 20 by 20 we're not using. I don't know why we couldn't adapt that to something, one of our, you know, the zoning or the environmental health. They both can move out there. If the veterans don't want to move out there, take them up the whole floor. I mean, there's all kinds of options. We're crowded here. We could move out there because there's lots of room. We don't have room for the public. We already got lots of property. We got lots of buildings. There's a good roof on it. You can ask him, is the roof pretty good on it and everything?
It's a newer road.
Yeah, it should be.
It's flat, but it's newer.
Yeah, I mean, it could be remodeled. We don't know. But it's something to at least look at. We haven't even toured it and looked at it and got any estimates on it. So that's my take.
My opinion is, I think it's an opportunity that's presented itself. It's near the base of operations. What we're discussing, of course, is that if we did build a building, the veterans would be on the first floor. It's slow traffic, there would be parking. There's parking lots. Yes, we do have property out here on Shiawassee Street or State Road. There's one entrance in, and the traffic is fast coming out, especially if you're turning left. Also, it would certainly help enhance downtown Toronto, let's be honest about that. And in this concept of this building, we have talked about a conference room on the second floor that would be big enough to hold activities. We presently have a tough time finding a meeting space that will actually hold more than 30 people, 35, 40 people at the most. I would also agree that sometimes the property presents itself, it may not ever present itself again, and so on and so forth. And the purchase of this property, of course, there's also the cost of tearing down the buildings and improving the lot. And then if we can make a deal with a landowner, the same person who owns on one side and the other side of those buildings that we would tear down, and so we would have the corner lot. There is the possibility in the future that we could build a building. And I agree a little bit. We have to take a look at how if we do something with, let's say, even Huntington Bank on this, so on and so forth. But I think for the minimal investment and close to the proximity of other departments in this county and proximity to this building, I think would be a very wise investment to purchase the land. Even if it was just a green space for a long time, at least we would have control of the land, and if there's ever an expansion, then we have some place to go for that activity. That's why I'm in support of it. I think it's a very good idea.
Well, and I think that's a good point, what John brings up, is that, you know, we do have a commitment to downtown Corona as our county seat. And we have an opportunity to have this land for whatever future use. And I'd like to throw it out there that if we don't buy it, that could end up being a marijuana dispensary. You know, it keeps downtown Corona moving forward. So that is just one thing I would consider.
Preemptive purchasing seems to be a bad policy.
Wouldn't be our first bid policy.
I mean, do any of you, considering the cost of the building and the tear down, if you see in the near future that we could afford such a thing?
Well, I don't know, possibly.
We also got a building we're not using right now.
There's free trucks, free money,
Oh my God.
maybe.
Well, anyway, any other discussion this time? If not, we'll move it on to Wednesday. All those in favor say aye.
Aye.
I thought I just said
Oh.
discuss, I don't think there was a motion.
Okay, we'll move discussion to Wednesday. I'm sorry.
Just wanna make sure we do it.
Okay. Okay, let's move on to item E. We need a motion to approve the contract with the Circuit Court Association as presented.
We don't have a contract. There is no contract attached, so I don't know how we can approve a contract that we don't have.
So Eric will have the final version. He sent it to the union today, I believe. You got the red line version. And so that has all the track changes in it. We do have the track change version if you'd like to see it, but it's for review by them. And you can,
We can discuss it again in Wednesday.
Well, yeah, I'm not gonna vote on approving a contract that I don't have.
Okay, second discussion item.
I mean, that's
Okay.
bad policy.
Let's move on to F. I need a motion to approve the purchase of a Ford F-250 Super Cab in an amount not to exceed $32,291 and a Ford Escape in the amount not to exceed $23,510.
So moved.
Support.
Okay, motion to support, discussion.
those are for buildings and grounds, so I'll let Tim discuss that.
Yeah, basically, I've got more employees than I have vehicles for them to drive. And, the other part of it is I don't think that we'll probably get these or see them until sometime next year. Or the first of the year, maybe if we're lucky.
Yeah.
But I wanted to get them on the agenda and get moving forward.
Yeah, a couple of the things that we did during budget discussions is this time frame of certain commodities is going to be very difficult to get in a timely manner. So if we get them in the order bank, even though we'd like to have them yesterday, so to speak, in a sense, it won't be here till sometime next year.
The other side of that is if you purchase them, or if you agree to purchase them now, they will be built into the budget that you adopt next month.
Hey Tim, what's the life expectancy on these? I mean, how long do you generally think that you're gonna keep these vehicles before we get rid of them?
Well, you have two ways of thinking on that. You can keep them until they're worth nothing, or else the other thing is after a few years, trucks hold their value. A lot of counties, I think you have to hold them, because they're through state purchasing, I think you have to have them for a year or two, but after that, you can sell them. A lot of times, you can sell them for the same amount of money that you're gonna purchase a new truck with. You can get like, kind of almost like a revolving equipment, so that after a certain amount of time, if you sell them within the next 2 or 3 years, you can probably purchase the same truck for the same price.
Yeah.
So we don't have a regular thing we do right now?
No, right now we don't. What's happened is they've kept the trucks so long. When I first got here, they were in terrible shape. Right now we have a good set of trucks. We got basically 3 that are, 2 are plow and one's just for moving around in. but, the trucks were bad. I mean, we got one sitting there right now that's not even running, but I'm gonna probably send that out to auction or whatever and see, you know, it's really not worth anything.
I guess I'm trying to just wrap my mind around how long a truck lasts. Are we talking about a truck that's 10 years old, 15 years old, 5 years old? How long does a truck last before, you know, you would expect, well, it's gonna kind of be a piece of junk and.
I would say probably 10 years before you start putting a lot of money into it, or so.
Yeah, and keep in mind here, these are bid price, and Ford has a very good bid price with the state. This truck that we're asking $32,291 for, that's probably as a retail of $65,000 for the public if you walked into the dealership. And where used trucks are, and there's a real shortage of used trucks, you can just, you look in the paper, this truck 3 years from now might bring $45,000, we paid $32,000. So we're actually in a position now, maybe to move things after 4 or 5 years if we so choose, and then keep purchasing at the net state pricing.
Right.
And Tim has some equipment he's going to be getting rid of as well.
The Tahoe.
Are they gonna hold that price down then?
I do believe that they will hold that
Yeah,
price.
that's the price through the end of the year.
Right,
Yes.
Yeah.
as long as we
Then it'll be-
okay it, yeah, I think that it will be.
Yeah.
And also, I think maybe they ought to be taken care of a little better. I guess I got a truck that's 18 years old, it's got 213,000 miles, and it runs good and it looks good, so if you take care of them, and I haven't put a lot of money, it's got the original motor, transmission, and body and everything on it, so,
Mine's 27 years.
yeah, so.
Use it every day. Heavy
So-
duty F-250.
so.
Okay, any other discussion? If not, all those in favor say aye.
Aye.
All those opposed, motion carries. Thank you. Need a motion to approve the refilling of 2 positions in the sheriff's department, one for corrections deputy and one for road patrol deputy.
Support.
Motion and a support.
Just briefly, one corrections officer you know about, the deputy is going to be retiring within the next month and a half, so we'd like to get on the process of replacing the road patrol deputy for the retirement.
Okay. Any other discussion? If not, all those in favor say aye.
Aye.
Motion carries. Need a motion to approve the creation and hiring of a part-time secretary in the sheriff's department, not to exceed $10,000 for fiscal year 2022 without benefits.
Support.
Motion to support.
Just very briefly, this is not really the creation of a new position so much as this person has been there serving on a contracted basis, but it is more appropriate that they be an employee instead of a 1099 contracted individual.
Yep. Okay.
It only goes through the year 22,
Yeah, it's just a 1 year.
so we have to just up that every year.
That's fine. Okay, any other discussion? If not, all those in favor say aye.
Aye.
Motion carries. Thank you.
Mr. Chair,
Yes.
one last thing, it's not on here, but Commissioner Root asked that we look into what a 4% increase would look like. So in the event that the board authorized a 4% increase to keep the wage study current, for the health department, that would be around $52,000 for 26 individuals. For the non-reps, which includes district court, it would be around $110,000 for 57 individuals.
Okay. I'm sure we'll discuss that some more. Yeah, we have been discussing it. Okay. Anything else from commissioners today? Anything? Chat about it? Okay, no, not. Call the public.
Just a quick question,
Yeah.
Mr. Chairman. On D, the approval of a land purchase, what are they asking for a cost?
Around $47,000.
Thank you.
Okay, anything else from the public? No? Yeah.
Yeah, and also, if you wanna tear it down, I don't know how you're gonna tear it down, the walls are compatible with the other buildings. I mean, it could cost $100,000 to tear it down, and there's no parking out there, there's lots of parking, so I don't know why we would wanna move somebody out there. Not necessarily the veterans, if they don't wanna do that, you can move the zoning in the environmental health, they would work together, move them out there. So, and it's not used as a building, it's a great big building, it's a great, lots of room.
Okay.
If we'd had $100,000, I'm sure to do a lot of remodeling out there for that amount of money.
Okay. Thanks, Gary. Anybody else? Meeting adjourned. I gotta hustle.